I'm Joe Galvin, Chief Research Officer for Vistage, and it's my pleasure today to welcome James Jack to an interactive session here from UBS Wealth Management on the SBA EIDL loans and the Paycheck Protection Program. This creates a real lifeline, James, for a lot of our folks and a lot of our members, and it's generated a lot of questions. There's a lot of confusion as the program is rolled out in varying degrees and varying levels of execution. It's generated a lot of questions, so we're really grateful for you to spend some time. James is the head of the business owner client segment for UBS Wealth Management, and is going to take us through some of the things that he has learned, that they're experiencing, some of the frontline stories of people out there to get some clarity to this program. And then we got a long list of questions we're going to walk down. So, James, thank you for your time this morning. Just as a time check, this is Thursday, April 9th. These things tend to change very quickly. We had an announcement just this morning. So please take us away, and we'll follow up with questions. So, ladies and gentlemen, James Jack from UBS Financial Wealth Management. Thanks, James.
Hey, Joe. Good morning, and thank you everyone who's listening in. I really appreciate the opportunity to speak with you all today and answer hopefully many of your questions. Like Joe said, I head up our business owner client segment here at UBS. We have been getting hundreds of questions from our financial advisors and our clients about what all of this means. So first thing I would say is, for all of you who either own the business or are running the business, you're not alone. And that may be, an understatement of the century. Things have really changed. And like Joe said, things are changing every day. If we go back to last week, one day we had one set of terms and the next day it was entirely different almost. So what we've been doing, my team and I have been really diving deep into the material, understanding what's going on, working with our team in Washington who has connections with the Treasury, and to figure things out. The first thing I'm going to say is that UBS is not a lender in this program. I will give us a little bit of a hype, is that we announced yesterday that we're committing $2 billion to buy these loans from lenders. So many lenders may not have the balance sheet to make these loans, and that's kind of some of the problem that we're seeing right now with this tremendous demand. So what UBS is doing is, since we don't have the operational process to build these, the payroll documents and review that, how we decided to help is we'll buy loans from people who are experts and clear up capacity that way. And then we're going to donate the fees that we get from that to our local small business community. So we're really excited about that, and I appreciate you giving me the opportunity to explain that. But that comes down to, what's going on. I'm sure many of you have already tried to apply for a PPP loan, a Paycheck Protection loan, or an economic injury disaster loan, an EIDL loan from the SBA. And what I want you to know is, if you haven't heard anything, or if it's taking a long time, again, you're not alone. This is happening industry-wide across all of the banks. If you think about it, the banks had, 3 or 4 days to build a loan program. And if you heard the expression, driving a bus while you're building it, we're still doing that. There's still so much we don't even know yet from the in terms of rules. So I'll talk a little bit about what we do know, what we know for clarity, what things have come out, and then I'll also talk about what we don't know. But it should be good. And then, like I said, like Joe said, there's a lot of questions, and many of them are really great and technical. So I appreciate that, and we'll try to answer them if I don't get through it in my regular speech.
Also, James, a quick note, you have a presentation. We're just going to focus on this chart, but behind it is a lot of really great detail. And I want everyone to know this presentation is available for you to download and absorb and take in the pieces. Good. We don't have time to go through all the details, but want to let you know that it's available for you. So thanks, James. Go ahead.
Absolutely, Jeff. Thank you for doing that. Yeah, we'll make this available to everybody. I'm going to keep to about 2 slides on this document, but there's much more in detail behind this. This one is just kind of 4 things you should know about the various relief programs that are available, and we'll touch on all of them. So I'm just going to start diving into it. So the first thing is the Economic Injury Disaster Loan Program, or EIDL. That was what was announced as part of the Families First Coronavirus Response Act, sometimes known as Phase 2. And it's very close to a traditional SBA loan. Many of you may be familiar with that, but it does have a personal guarantee. There is collateral that they ask for, but it's a low interest loan and it's a long-term loan. Slight nuance to that is that if the loan is less than $200,000, there actually isn't a personal guarantee. They made an exception for it. So there's an opportunity that you could potentially get a loan in this program that while not forgivable, doesn't have a personal guarantee, and that's only if it's less than $200,000. If it's $200,000 to the maximum, which is $2 million, there is a personal guarantee required by the borrower. The term is up to 30 years of maturity, and there's two potential rates, either 2.75% for nonprofits and 3.75% for small businesses. It does require some credit underwriting and collateral and personal guarantee, like I mentioned, and it's a non-forgivable loan, so you have to pay this back. One of the interesting things about this program, though, is there's a one-time $10,000 emergency grant at application that's available that, you don't have to pay that back. You can request that and just get that $10,000. There's talk of potentially altering this $10,000 to $1,000 per employee. I've seen that in the news, but as of right now, as of this morning, it's still $10,000. So, continue to monitor that for now, but that's, it seems more rumor than fact.
Hey, James, can I jump in with a question on that one?
Yeah.
I understand that program, that kicks that off within 3 days of submission. Are people actually receiving this money now, or is it still out there in the ether?
I have not heard of a single person who's gotten it. So that doesn't mean it hasn't happened. But I think what the SBA has done is they said that the focus is on the PPP program. That's where overwhelming demand is, and that's where Congress wants people to be going. So the SBA's resources are mostly focused on the PPP loan. Much of the EIDL loans, from what I've been hearing from our clients, is that it's kind of like they sent the email in or the request into the SBA, and we'll get back to you. So I think their prioritization is that. Now, that said, is Joe, what you mentioned is when you ask for the grant, you're supposed to get it within 3 days. So while I haven't heard anyone who's gotten it, technically they should be able to get it if it's just a matter of getting the application and providing it. So I think that's the key nuance that might be happening there. I'm going to move over to the PPP program because I know that's the one that everyone is probably focused on. This one is complicated. They've built a program that is intended to be simple and with a quick application process, but it really is, much like many things, the devils are in the details, and that's where a lot of the complexity comes in. This program is available for small businesses, nonprofits, independent contractors, sole proprietors, and some tribal organizations. I'm going to keep this conversation mostly to the business owners and contractors and sole props. On the nonprofits, there's two types of nonprofits that are eligible. It's 501c3s and 501c19s, which are some certain veterans organizations. So if you're organized as a nonprofit in a different structure, as of right now, you're not eligible. Everything else, though, is the same for nonprofits. So even though the application may say business or something like that, at a certain part, you're going to check that you're a nonprofit and everything else is applicable to you. So just, use the terms in that context. But it's for those types of entities, and it's for 500 U.S. employees, up to 500 U.S. employees with some limited exceptions. And that U.S. employees is actually an important nuance that was just added a few days ago. So originally it was 500 employees. Now they added U.S. employees. So effectively, if you have operations internationally, those employees will not count against you. So, if you've got, let's say, 600 total international employees, but only 400 of them are their principal residences in the United States, you are eligible for this loan. That's something that's important, I think, I'm sure for many of the companies in Vistage. Also important is, we get this question a lot, is what if someone who owns this company with more than 20% or even up to 100% is a foreign owner? There's I think some lack of clarity on this, but this is my take. I'm going to go out on a limb. If you read the documentation, they have very explicitly said who's not eligible. And it has nothing to say about ownership being, if they're foreigners or not, being ineligible. So my take is, if it's a U.S. company with U.S. employees and they agree to certify to the asks of the loan, which are that you're going to continue to maintain payroll, you'll buy American as much as feasibly possible, and some of the other things, you are eligible for this loan. So that's, I think, important. We get that question a lot. So I want to make sure you guys all know that, just, even if someone is more than 20% as a foreign owner, you should be okay. Also, I've gotten a question, if the entity is public, does it apply? And there's no exclusion specifically mentioned if it's public. Again, if it's for U.S. payroll, less than 500 employees, then it should be fine. The only nuance to that, I would say, is when it comes with affiliation. And I'm going to talk a little bit about that a little bit later, what, like private equity owned and venture capital owns, I would say the same is similar for public companies. So I'm going to table that for a second. I'll come back to it. Let me keep going through the key parts of the loan here. So up to 500 employees, the exceptions are if you're a hospitality or restaurant industry, so it's NAICS code 72, you actually can count yourself based on the number of locations. So let's go back to another example. You have 10 restaurants each with 60 employees, that's 600 employees, right? You might think you're not eligible, but because restaurants are given this exception, it's on a per location basis. Each of them are below 500. You're okay and eligible to apply for this loan. What are some of the other exceptions? If the SBA has already said that based on your size, you're still a small business in your industry code, then you are eligible. So there are certain industries like mining and others, it's all available on the SBA website, where they'll say either revenue-based or employee-based, and it could go up to 1,000 employees. Those ones are eligible. Our understanding is that they are not using the revenue test for this. It's purely based on U.S. employees, so you can ignore that. What's the loan amount? This is kind of the big question in the first week, is what do I even get? So it's the lesser of 10 million or 2.5 times the average monthly payroll. Plus, if you had gotten an EIDL loan, they're gonna kind of refinance that and bring that back in if you plan to use it for the same purpose. And so average monthly payroll, we get a ton of questions on, is it 2019? Is it the last 12 months? How does it operate? And the answer is, it's both. It's either one. So the law actually says you're supposed to use, for an established company, this example is, so someone who's been around for a while, you're supposed to use the preceding 12 months from when you get the loan. But the Treasury produced an application which caused a ton of confusion. And in that one, it said average 2019. So in their latest frequently asked questions document, they address this question and they say it's up to you as the borrower. So you can make a determination of what you need. So it might be, you might want to do whatever you think gets you the most, or maybe you think whatever gets you the least because you don't want to potentially carry a loan. So you can run that math, whatever's easier for you on what that works. What's in payroll? I'm going to go into this a little bit later because this one is really a little bit more detailed, and I have a slide that will talk about it. So I'm going to come back to the specifics of payroll. Who's eligible? I think it was a kind of another question that's on the list in terms of if it's a new company or not. What they're going to look for is, did you have an employee or a contractor in your business on February 15th, 2020? If the answer is yes, and you were, open for business, you can ask for this loan. So that's kind of, if you were a newer business after February 15th, you're not eligible for this. With a newer business though, let's say you opened up in, January, how are you going to go 12 months back? You can't. Those businesses can elect to do January and February and do the average payroll of that period. So there's a slight difference there. There's also a slight difference if you're a seasonal employer. You're going to use February 15th to June 30th, 2019. So you're going to kind of use the same year-over-year period. What's the rate and the term? It's 2 years and 1%. If we did this call 9 days ago, I would have told you it's 2 years and 0.5%. And if it was 10 days ago, I'd say 10 years and 4%. So you probably heard a lot of different numbers. The final number that was the actual result is 2 years and 1%. And that's been codified over the weekend. That one's set and done. There's no standard credit writing under this. So I mentioned if you've been through an SBA program, they ask you, have you tried to get credit elsewhere? Do you have assets yourself personally? Things like that. All of those requirements are waived. You don't have to worry about them all. There's no collateral and there's no personal guarantee. The other exciting thing about this loan is it's forgivable and it can be turned into a grant. And there's a lot of details about that. The important thing here is the rules on forgivable loans are not finalized yet. As of the 9th of April, still have a lot to go there in terms of figuring that out. So I want to make sure that you guys know that what I'm telling you is what we know as of right now, but there's much more to come. The way you get these loans forgiven is that you maintain a level of payroll, and I'll get into that in a bit. But that's the goal of this loan, and if you understand that going into it, things will start making sense. The goal is to keep people employed, to keep them off of unemployment, so that when things do open up, hopefully, late May or June, that you guys can immediately begin ramping back up, and we can hopefully get a V-shaped recovery. That's the goal, and that's why they've built and designed it this way, because they think if you put people on unemployment and then you have to rehire new people, that will further slow things down and hurt the overall economy even further. So that's the intention. The loan is meant to cover the next 8 weeks of your allowable costs. The allowable costs are payroll, rent, utilities, interest on mortgage obligations, and interest on other debt obligations. An important key point, though, is when it gets to forgivable part of the loan, the first four are specifically listed as forgivable. That fifth one, the other interest debt obligations, is not. So there's a chance that while you can use it to pay for those for that interest, you can't get it forgiven. The other thing is you can only get the principal forgiven on this loan, so you still will owe some interest. But like I said before, it's a 1% rate. It's pretty small, and actually your first 6 months of payments are deferred, so you don't have to pay anything on this until July or so. So there's you're going to keep liquidity in hand. I'm going to move on. I'll come back to the specifics of forgivable loan and what payroll is in a bit, but just to complete the other two boxes. What if your business is more than 500 employees? Then what's in it for you? This is another one where we know very, very little. The Treasury is supposed to start coming out with details this week. I haven't seen it yet, but they were asked to by the actual law. There's $500 billion applicable for this program. Actually, sorry, real quick, I want to go back to the PPP program. There's $350 billion for that program, 349 actually. It's first come, first serve. This is the other part of everyone swarming in on this program. We're fairly confident that program will be expanded. We heard from Senator McConnell yesterday that he plans to ask for between 200 and 250 billion additionally. So while not guaranteed, it seems fairly clear that everyone's recognized that this program needs more money. So first come, first serve. We think they will last for a few weeks, especially if they add a few hundred more onto it. So yes, sir.
Yeah, we've had a couple questions come in. Like one bank in particular said, we only have X amount of money. We've given out those loans and they close the window. Others are concerned the rush to the window, who gets there first. If you don't have an established relationship with a bank, you're at the back of the line. And again, no one knows for sure, but it's your belief, as well as many others, that the government will continue to feed this program to satisfy the need.
It is my belief. I wouldn't say it's not a guarantee, but that's what I think. On that particular question about, is it first come, first serve, or does each bank have their own allotment? It's first come, first serve. That particular bank, and I'm not going to mention them by name, but that particular bank had issues where they were penalized by the federal government for opening accounts faultily in the past. And as a result of that, their balance sheet was limited. They couldn't grow. So that was what they were referring to. They were very specific in their requirement. That said, I think as of last night, the Federal Reserve has given them, an exemption of that limit for PPP loans. So that bank, if not already, will begin ramping up again. I'm positive. So that's the nuance there. But other banks, they're kind of going in first come, first serve, and they're going through it. I think what also is causing a delay is maybe it's their own personal balance sheet that they have. Do they have space for it? Operational complexities, just the amount of bandwidth coming through. Like the SBA site crashed on Monday, so you can't get loans done. And then other banks' websites, their sites have crashed. So banks are juggling a few different things. And, I liken it when I tell our clients, to be patient about it, is if you thought getting toilet paper was bad, right? Or you've heard the unemployment side, it's just not meant to do this. The context is in the first 2 days of this program, the SBA issued more loans than it did all of 2019, in terms of dollar amount. So just put that into context, like, oh my God, like these banks have been swarmed. And so they're doing the best that they possibly can. I'm convinced of it. And the government is trying to alleviate some of that. And that's why UBS, I mentioned, we put up to $2 billion to buy some of these loans off of lenders who can originate them so that their balance sheets clear up and then they can make the next loan. Going back to the bigger business one, this one, there's no real defined requirements. It's the Treasury, the Secretary of the Treasury, Steve Mnuchin, he's given broad discretion on who he wants to give these loans to. And not only is it a loan, but it's also guarantees or even investments. They'll make investments in distressed companies and ride out on that and potentially win on the value going up. These are non-forgivable loans, and they're up to 5 years, so the actual time will be determined, as well as the terms and other kind of criteria that they'll use. But there's some requirements. You need to maintain 90% of your payroll through September 30th. They use, I think, March 24th as the date that they compare it to. And then there's also limits on compensation above $425,000. Those people, their compensation needs to stay as it was in 2019. But if they're more than $3 million, there's actually a reduction that's required for people who make more than $3 million. So there's some devils in that, and it's for the period while the loan is outstanding plus 1 year. In that same period, you can't do stock buybacks, you can't do capital distributions to investors or other types of dividends. So there's limits on that. This was a big part of why the bill was delayed a little bit. The Democrats wanted to put protections in that, they're not funding kind of investors. There's also a caveat, a wrinkle for mid-sized businesses, and we've gotten a lot of questions on this. So if you've got 500 to 10,000 employees, there we know that the loan will be 2%, up to 2%. And there's all of the restrictions I just mentioned, but there's also some additional ones when it comes to unions and collective bargaining. So these ones, the term is a little different. So while the loan is outstanding plus 2 years, whereas the other one was plus 1 year, the company can't abrogate collective bargaining, and they're making a commitment not to outsource labor. So that's for the loan plus 2 years of that collective bargaining and outsourcing. And then additionally, for the period while the loan is outstanding, just during the period while the loan is outstanding, so there's no addition on this one, there's additional requirements about remaining neutral on union organizing. So we've heard from business owners that they're concerned about the stock buyback or the compensation, as well as the potential union issues. you're really going to need to dive into that when we get those details. That's all we really know about this program. There's still a lot more to come on that one. And this then raises the question, well, on the PPP program, can I still give a dividend to what if I'm the owner operator, the K1 dividend or something like that? And as far as we can tell, there's no limit on that. You can still do that. They expect that, they know that small businesses, the owner's livelihood is based on that K1 distribution. It's not going to some, large fund or something like that. So there's no specific limit on that program as it comes to dividends. But what is important is that loan you get must be used for payroll. They tell you that among a few other things. I'm going to go through this last part very, very quickly because then I want to come back to the specifics on PPP and then open it up for questions. There's also a ton of tax credits and deferrals that are available to you all. So there are two that are available that you can take if you don't do the PPP loan. So one is an employee retention credit on your taxes, and you can request that now with IRS Form 7200. So you can kind of get that prepaid. It's up to $5,000 per employee. And then there's also a deferment of your payroll taxes, the 6.2%. You can defer 50% into next year and then another 50% into 2022. We really recommend that, for businesses to talk to your tax advisors and run the numbers. It may be that those tax deferrals are as good or almost as good, but without all the agita of the PPP program. I don't know if everyone knows agita. That's kind of a Italian-American expression of like the angst of the whole thing. So that may not be worth it. So you might want to run the numbers and see, but my guess is the PPP program will be overwhelmingly better for people just because, it's largely forgivable. And then what isn't forgiven is that a 1% loan for 2 years, it's a very payable loan. So just something you should think about. And then there's also changes to the net operating loss rules. So you can actually take losses this year and next year and run them up against profits from up to 5 years in the past and get a refund back. That was something that used to exist but was removed when they did the Tax and Jobs Act a few years ago. They've kind of brought it back temporarily. And then this is another great one that we're advising clients on is the interest deduction for businesses has gone up from 30% to 50%. So if you are lending, if you are taking advantage of these loans or some other bridge loan or whatever, that loan now is effectively the rate's in half. It was 30%, but now it's, so it's not entirely that. But that's an opportunity maybe that if your business needs this lending, or if they're doing well and needs to think strategically, right, and take an opportunity to grow, if you can get a line of credit, this could be a great temporary advantage for you and your business. I'm going to go to the two specifics and then we'll open it up, Joe, for some other questions, if that makes sense. I want to dive into what's payroll and what's the forgivable part here. So on the payroll part here, I mentioned the calculation of your loan is 2.5 times average monthly payroll. And so they have a very specific of what they're including in payroll. It's your salary and wages or similar compensation, payments of cash tips, payment for vacation, parental, family, medical, and sick leave, allowance for dismissal, payments required for group health, including insurance, as well as retirement benefits and state and local taxes. If you're a sole proprietor or independent contractor, a 1099 MISC, you get up to your wages up to the $100,000 prorated for the period. Big common question we get is, I'm an employer, I have independent contractors, do I count them in my number and in my payroll? The answer is no, you do not. The Treasury, while it's written fairly clearly in the bill, there was still a lot of uncertainty on it. The Treasury has now put a definitive Q&A in their documentation, and they've said it. So you don't include independent contractors. Independent contractors and sole proprietors are able to apply for a PPP loan themselves, and they should do that. So that's one huge question we get all the time. Don't include them. The other one that we're getting is there's a limit of compensation up to $100,000. And so I get a lot of questions about, well, if I've got someone who makes $150,000, do I include them or do I only include the $100,000? And again, it's written again clearly in the rule, but they've really spelled it out in their frequently asked questions, which is you only include up to 100,000. So for the person who makes 150 in our example, it's, you get the 100, but not the extra 50 for your calculation. Related to that question is, well, what if someone makes, for the sake of simplicity, $100,000, but then there's an additional $20,000 for insurance and retirement benefits, things like that, all the other things I mentioned above. And the answer is you get to include those. So yes, those still do count. The limit on $100,000 is only for the wages portion, the salary portion. So the other benefits, retirement, sick and medical leave, health insurance, the taxes, those are in addition to the $100,000. What else do you not include? So you don't include any compensation for employees who live outside the United States. I referenced that before. You also don't include the qualified sick and medical leave for which you're going to get a tax credit as a result of the Families First Act. So you would strip those out. Those are extra costs for family and sick leave, which shouldn't really apply to the past because they're brand new. The other one that is an interesting thing that they updated last night, and it's interesting, is they have taxes for payroll, railroad income, and other income taxes that you don't include in your payroll calculation. They changed this insofar as on the payroll tax, you can include it in your calculation for your loan, but you don't include it for your forgiveness portion. So, that's another great confusion that they added. Instead of having just a simple rule that you don't include it, they've now made it you can get your loan, you can include it for the calculation of your loan, but it won't be forgiven. So you can't use you can't use the loan to pay new taxes, like your FICA tax as an example. So that's something that just came out last night, and that could make a big difference for some people. If you haven't submitted your loan yet, you might want to go back to your accountant or your payroll provider who probably has provided you some of your report and documentation to say, hey, it says that we can include it in terms of our calculation, and for the amount, we need to get those numbers. And if you need to provide it to your advisor on it, I think it's like question 16 on the frequently asked questions on treasury.gov. So they just added it the other day. It could be a pretty big change. And then just to finish up here on the forgiveness part, payroll taxes, what you can use it for payroll taxes. Now, like I said, the exception being is you can't use it for the taxes on that, rather. So you can use it for the cost, but not taxes. And mortgage interest, rent, and utilities. And you can also add some stuff for tipping. One other nuance that they added was, yes, you get 2.5 times payroll for the 8 weeks as your amount, but when you want it forgiven, 75% of whatever you get forgiven has to be used for payroll. So what they're trying to do here is prevent you from laying off all of your people and then using the money to pay for other things and then bringing them back on. And I'm gonna connect the dots in a second. So the other part about this is that what is forgiven. So how they look at it is, if you keep all of your payroll the same, no changes to number of people, no changes to comp, then the whole loan will be forgiven if you use it to pay for these allowable costs. But what they're actually going to do is they're going to do some math and say, how many employees did you have during the period, the 8 weeks on average, full-time equivalents is what they use, versus a denominator number that you get to choose. And there's two options. One is either February 15th through June 30th last year, or January through February this year. So you're going to want to run the numbers and see which one did you have fewer employees during, because you want to use a smaller denominator. That will be much better for you. That will mean more of your share can be forgiven if you do lay off some folks. If you're a seasonal employer, you don't get a choice. You have to use February to June of last year. The other thing that they do here, so actually, let me give a quick example. So let's just say you had 10 employees last year, and that's your denominator, and you now have 9 employees, either because you've let them go or they've left voluntarily. There's no exception for people who leave on their own. So that's 9 out of 10. That's 10% gone. So your forgivable portion will be reduced by 10%. So again, if you had a $100,000 loan, only 90,000 of it would be forgiven. Now, I stress this a lot with clients because people get really fixated on this. Is that $10,000 or that, in that example, that's still at 1% and payable over 2 years. That's a really, really cheap loan. So, and if it's keeping you in business, don't really sweat the small stuff on that. Do what you need to do for your people and for your customers and your suppliers to keep things going. And that small loan, that's left over, at the end of the day, you're gonna be like, oh, what a godsend it was. So don't get caught up on that. I know a lot of people do. The other part about what changes payroll is salaries. So for people who make $100,000 or less, they don't want you cutting their comp down by more than 25%. So they effectively don't want to they don't want you turning people into really low part-time working. And so the example here is just take someone who makes $100,000. If you cut them to $74,000 prorated, that's 26%. That's $1,000 more than the 25%. So that $1,000, dollar for dollar, would be deducted from your forgiveness. Important on this one is they say it's at the employee level, so it's not averaged out like the other calculation is. So they're probably going to request documentation that says, Joe Smith made X dollars before. What does Joe make now? And they're going to want to compare that. What's the big nit on this is there's an exception for rehiring people. And what I'm going to tell you is exactly what we know right now. It's literally just this. It's reductions in employment or wages that occur between February 15th and April 26th, 2020, will not reduce forgiveness if by June 30th, you eliminate the reduction by rehiring the employees or restoring their wages. That's all we know right now. So there's nothing about, well, can you fire the person on July 1st again? What happens if we don't open up the economy? I'm making a bet on that. Things like that. So there's a calculus you need to make about who do I let go strategically or furlough strategically now with the intention that I'm going to bring them back so that I can use the loan I have to pay for critical people and some of my rent and utilities, and then restore them so that I get as much of my loan forgiven as possible. That's a calculus you need to think about and really prepare for. What's critical, though, is, like I mentioned, is 75% of whatever you use and you want forgiven has to be used for payroll. So it's not like you can just get rid of everybody and then use the whole loan to pay for rent and utilities and mortgage interest. So
James,
that's something you have to calculate and think about. Yes, Jeff.
Can I jump in and ask a nuanced question that's connected to this? But there's the other program in terms of unemployment and expanded unemployment payments. And we've had some questions about people saying, well, am I better off leaving them, or are they better off going on and taking these expanded unemployment benefits? And if they do that during the course of time, but I bring them back by the 30th, can you share some light on where that balance is between what an individual employee can do versus how the business can do it, what the right answer is for both?
Yeah, so you're right. So one of the things that held this bill up at the very end in the last hour was a few Republican senators said, hey, wait a minute, we're adding $600 on top of whatever you normally would get from the state. There's going to be some people who are going to say, it's better for me to be unemployed. And that creates kind of this moral quandary. The answer is, unfortunately, there's no right answer. So for some employees, it may make sense for them to be furloughed and laid off and then say, hey, you're going to get this unemployment. You're going to actually get a few extra bucks because of it. This is really kind of probably more common in restaurants. But we're going to bring you back in June, and I need you to come back because it will help, keep the business alive. And I think that's kind of a conversation business owners are having with their employees about that and thinking that through. But that's definitely a concern for a lot of business owners about, do they think that they can trust that the employee will come back? Will they want to come back, et cetera? Now, that extra $600 is temporary. So I think it's important that everyone's under the context that, you're getting this extra now, but it's not forever. And, you need it. And as soon as technically I bring you back, or I'm ready to bring you back, that could impact their unemployment. because now the factory is back open based on unemployment rules. So understanding all of those guidelines is really important, and thinking that through from an employee perspective. And yes, you're right. I think a lot of business owners are doing that calculus.
We've heard just this morning, we heard from a member whose employees didn't want to come back, that in fact they're better off being on the unemployment and just leave me alone because of whatever reason. So this is obviously a nuance that's going to work out over time as we see how this pulls together and what makes sense. But really appreciate your insight on that one, because that's come up a number of times from our members.
Yeah, and I'll close and we can open up for questions, Joe, is just what else do we not know? So we don't know the specifics on what you just mentioned, as well as some of the other forgivable points. What I just provided you is basically all we know. So we don't know the nuances of bringing people back, of how long do they need to be after June 30th. What if this shutdown continues into June? My guess is if that's the case, they'll probably extend it or make some changes to the law. So we don't know that. We don't know the details on that $500 billion program. And there's still a few other things that we're waiting on. Sorry, one last thing actually before I open up, because I said I would come back to it, and I did it, is affiliation rules for venture capitalists, venture capital, private equity, and maybe public companies. They look to see who controls an organization. So if a company is a part of a portfolio company, and the fund owns 51% of that company, that's considered controlled and owned by that portfolio company. And what happens is all of the companies that fund controls or individual are rolled up together. This also happens with people who've got multiple LLCs or entities, but it really is one holding company. They're going to roll it all up together based on common ownership. So this really can impact venture capital and private equity, and it also impacts even if they have a minority position. So if you have more than 20% is owned by a private equity or venture capital, but they can control the board. They can prevent quorums, they can do other things, even though they don't have more than 50%. The SBA considers that to be control. And so the workaround that some law firms are doing, and again, I invite you to speak to your legal advisors on this, is they're temporarily suspending some of those rights, those rights that those minority owners might have, so that the control is broken. So that's something else to think about. And I think the same is the case with public companies. Who owns more than 20% of the company? That's who the SBA wants to know about, and that's how they're going to start connecting the dots. So if a public company is owned, if someone has control of it, either from owning more than 50%, or they can prevent things because they have enough, voting rights that they can prevent the board from doing things, that's control, and the SBA would then compile everything up based on that owner. So thank you. I know I kind of rattled on, but there was a lot to it. But hopefully I answered most of the questions on the list. And Joe, I'll turn it back to you.
Well, great, James. Thank you so much. The level of detail and specificity you're able to provide has been really powerful. As so many of these questions are nuanced and uncertain, as you mentioned multiple times, we just got this, we just got that. I want to let everyone know that we will make this presentation, that the few pages you shared, but there's more detail available to you, along with the government just released new guidelines last night on PPP. We have those, we'll make those available as well, knowing that they could very well change by this afternoon, but we got to go with what we got when we got it.
Exactly.
And James, I just want to say, I really appreciate the fact you mentioned earlier you're holed up in a one-bedroom apartment in New York City. I'm really grateful for that, because all you can do is work on this stuff. You got nothing else to do, so so we appreciate that.
Exactly.
So let me go through. We've been compiling questions that come both through our networks as well as are fed to us through our chairs from members. So many of which you've asked, but I want to just make sure we tick these off to make sure we get these answers out there. And again, appreciate your time. So starting with calculating payroll for PPP. This is a question. I'm a first-year business, have yet to file for payroll. I'm the owner. I've taken money to pay myself, but not payroll yet. I was in the process. Is this person eligible to file for PPP? And how does he account for the money he's taken during this year?
So they are, if they had people on staff and were open for business on February 15th, 2020, on or before. So if it happened afterwards, they are not eligible. Beforehand, they are. And so that comes, okay, well, I don't have documentation. What we tell our clients is, because the government hasn't said, go to, IRS form 940 line 10 or something like that. They haven't provided that level of specificity. So what we tell people is, think about when you go to get your license renewed at the DMV and they say they want, 6 points of identification, and you bring 10 because you don't know who the person is on the other side of the counter. Do the same thing. Unless your lender tells you specifically what they want, err on the side of inclusion, document what you can, and inundate them with the evidence. Do it in good faith. If you're doing it in good faith and provide them the documentation, that's all the lender needs. That's what they can go on your good faith certification and attestation.
Yeah, we put out a piece the week before last actually, on the things you need to do to prepare for this. And to your point, it's have your documentation with you, be as complete as you can. That's just going to expedite the process.
Yeah.
So
Yes, absolutely.
Okay, next question. How do you calculate FTE? What is an FTE employee if you primarily have part-time employees? How is that calculated?
Yeah, so it can depend, but the typical rule of thumb is about 30 hours a week. So that's generally how they're using it. I would say consult your tax advisor, specifically on your situation as always, but rule of thumb, 30 hours.
Okay. Let's talk about CEOs. A CEO distribution versus payroll. How does that fit into this calculation?
Right. So we get this a lot with like partners of an LLC or something like that. So if it looks like a dividend, it doesn't count. If it looks like compensation, it does. And so I don't mean to be kind of, wary on it, but it's not really written. So it says wages, compensation, or other similar compensation. And so if you think it's not a dividend and it's really like a draw or something like that, or a bonus or whatever, it will count, I think, if you show the evidence and do on good faith. That said, it's only up to $100,000. So anything above that is irrelevant.
Okay, excellent, thank you. If we're paying 2/3 salary under EFMLA, is that just includable in the calculation for PPP, or are we still paying 2/3 in salary and benefits? Again, detailed questions, but you're the detail man.
Yeah, that one I'd say is much more of a tax advisor, but I think how I've read it is you include your employees who are full-time, part-time, and any other status, so like leave of absence and things like that. So I think you're counting that payroll in the past of those individuals and would include it. But ultimately, that's much more of a technical question for an accounting firm.
Yeah, that's one of the roads we're getting to. Again, your level of detail is impressive, but it still gets the point. Get with your banker, get with your tax advisor, and be ready when you get to the window.
Totally. Big team. You should have a broad team on a lot of things. This is definitely one that if you got the nuances on.
Yeah, last one, eligibility. If my mortgage and utilities and other eligible expenses exceed significantly from the 250% of payroll cost per month, can I apply for another program?
So this is a great question. You can only apply for the PPP loan program once. So I'm going to say this, then get to the question is, you need to ask for what you think you can pay and what you think you are entitled to. You can't say, oh, I put in for $500,000 today, and actually I could get $750 in total, so I'm going to go for $250 tomorrow. The government has explicitly said you can't do that. So be complete, be accurate. Now, and the specifics about, okay, well, all of my other expenses are way higher than this, so I'm not going to get anything for it. Yeah, you can go to the EIDL loan, the EIDL loan, but you just need to make sure that your purposes don't overlap. That's what they say right now in terms of how you can get both, and that's like I said, up to $2 million and 3.75% for profit companies. But I think that loan will take a significant amount of time. That's directly with the SBA. Yeah. Their focus is on the PPP program. So you might, if you need to, find potentially private lending.
Okay, great, thank you. Let's shift to PPP forgiveness. What are the things to do or not to do in order to maximize your forgiveness? I mean, it's kind of a general rule, but this forgiveness is out there. How do you really leverage that?
First thing is document everything that you're using this loan to pay for. Funds are fungible, but they're going to want evidence. And so they actually are going to ask for evidence about for rent and utilities and mortgage interest, were these contracts in place before February 15th? What were the costs of these last year, if you had them last year, or in a approximate previous period? They want to see, and they're going to track that. So get that documentation in place between now and sometime in June when you ultimately submit for forgiveness. So be prepared. That's, back to Joe, your point before. Part 2 on is you need to make sure that whatever you're getting forgiven, 75% of it is for payroll. So you need to have those people on board and that you're paying them. And it's during that 8-week period. That 8-week period begins, based on clarity last night, once you get the first disbursement. So you might apply today, but once you get the money next Tuesday, it's 8 weeks from next Tuesday. So that's an important nuance that we just found out. I should have mentioned before. But really document, gather evidence, and provide it to your lender. Inundate and do in good faith.
Overwhelm them with data and reports, right?
Yeah.
Okay. Moving on. Is there a reduction in forgiveness of a loan if we turn off matching contributions to a company IRA benefit? Again, details, but.
Yeah. So this isn't specifically mentioned. So I think as long as you're maintaining 25% or 75% rather of their salary, then you should be fine. And it's only mentioned as salary. So those retirement benefits, I think, are different and separate. Now, to a different question, which is not what you're asking about, is you have to look your employees in the eye after this is all well and done. So if you're laying them off or you're doing something kind of fishy or something like that, if they're meant to be in a long term, you want to make sure that these changes are like everyone's in the boat together. That would be my just personal advice to everyone here. If only certain people are taking the brunt and you as the leadership or the ownership are not, your employees, your customers, my guess, are going to hold it against you when we come out of it. So I would caution those changes. Do what you need to do to keep the business alive, but make sure it's transparent and clear and communicated, and that it's kind of like we're all in this together.
It's a sidebar, but we were in, as you know, unemployment was at 3.5% 6 weeks ago. And everyone was looking for talent, and everyone's trying to figure out what to do with talent. And memories, processes are short, but memories are long. How you treat your employees today and how you treat your customers today, once we get through this, they'll remember, and you'll be rewarded or punished based on the decisions and the actions you take. So
100%.
we will be back. It won't be long until we're back in the talent wars looking for people. And it's interesting because you've got this whole swarm of free agents, effectively free agents out there.
Right.
And will you be able to sign your own free agents, or are you going to lose them to somebody else? Because we'll get to that game really quick. Anyway, I don't want to get off the way because I got your brain here. I want to keep it on it. Okay. I'm personally funding my company payroll. Can I get reimbursed by the protection loan?
Yeah, I don't see how that's any different really than the others. If you can support and evidence that you have employees, full-time equivalents, and that there's payroll being done, that there's payments going on, then yes. A nuance to that, though, is when I think of personally funding payroll, and I don't think, Joe, this is what this person meant, but if you have household employees like a nanny, they're actually explicitly excluded too. That was a change on it. So, but if you're paying for payroll, whether from your pocket or from the company's revenue, it's still something you can get forgiven.
Excellent, thank you. We've not reduced salaries yet, but we did freeze scheduled increases. If we resume intended increases in pay, would the additional costs be covered?
Well, I think it's all about the allowable costs of the PPP program are for payroll, rent, utilities, and mortgage interest costs. So it really is irrelevant, I'd say, in that sense. But what I would say is, what you might want to look at is some of your contract law, right? If this is contractual changes and things like that, you may need to look into that personally. But it's not really brought into the topic here.
Okay. Some questions coming in about the loans and how they're funded through SBA lenders versus the government. Has the pool of SBA lenders expanded to other additional lenders, or is the pool that existed before the pool we're playing in? Okay.
Yeah. So one of the law changes is that they're making it easier to become a what's called a 7A lender, an SBA lender, so that they can get more expansion. So yes, it is. But the problem is those lenders are not used to working with the SBA. They're building this on their own, so they're coming up to speed much slower than the others.
Yeah. Well, we've heard from some members specific to that prior situation we mentioned, but in other situations where they don't have an established relationship with an SBA lender.
Yeah.
consequently, if their bank does get online or doesn't, how do they get into the front of the line is where that question leads.
Well, the reason why that's being done, it's being done a few reasons. A, to measure capacity, right? But one of the nits that was thrown in here is the government says, you need to also perform due diligence on these customers, know your client, and anti-money laundering. It's a big part about kind of protecting from terrorism and drugs and stuff like that. All of that is very cumbersome. So it takes potentially days to do that. So when this first was going through, the bank said, do you want a program that's fast or do you want a program that doesn't have fraud? You have to pick one. And so they kind of made some balance on that. And now the banks can take on good faith on a lot of this, but still they have to perform that due diligence. So banks that have already done it on existing customers, they don't have to do it again. And so that's why we recommend, and others are doing it in terms of that should help things move along faster. But it's certainly a lot of businesses don't have commercial relationships, so it puts them in a bind.
So for those folks that are maybe shopping around, have you even heard the online cabbage, as processing loans? Do all lenders use the same application, or do they have their own? It kind of varies, but everyone's in the same box then.
Great question. So the basic application is the same, but each lender is going to have nuances to it. All the terms and everything else are the same. So it's not like you need to rate shop. I would find someone who will get you the loan and go with them. You can't submit more than one application either. That's important. That's technically against the law. So you could put your name into multiple banks so that you're on their queue. That's a lot of people are taking names and then they'll get you an application or a portal over time. You could put that into multiple banks. Just know though, you're clogging up and causing problems if you do a lot. So maybe two. But once you get an application, you got to stick with them.
Okay. Let's shift a bit here because now the questions move to the EIDL or the disaster loans as compared to the payroll protection program, right? And this is an opinion question. I'm not sure you can answer it, but what situation is a better option? Is it the EIDL or is it the PPP? And should you do both? Look for either. What's your thoughts on that?
So again, I would caution everyone to speak with their financial advisor and their tax and potentially even legal advisor on these questions. So, but my take on it is the PPP loan is forgivable. There's no recourse and it's 1% over 2 years. The EIDL loan could potentially go up to 30 years, is still a small rate, 3.75% for for-profit companies, but there is personal guarantee for above $200,000 and there is collateral. Also, it seems like the SBA is taking more time on that loan. So from that standpoint, I think you can make a determination on what you might like, but you really always need to be talking to your advisors about your situation personally.
Now, your tax advisor, your wealth advisor, access your Vistage group and your Vistage chair and the resources we have.
Yeah, absolutely.
To bring in all those trusted resources. Okay, on this $10,000 grant, right? Is that going to be taxed? Is that considered taxable income?
Yeah, it's a great question because it actually also applies to the PPP one. PPP is explicitly said to not be taxable income. So anything forgiven there doesn't count for that. So that's a great question. On the $10,000 grant, I haven't seen it explicitly said one way or the other. Typically, grants do count as taxable income. But my gut is, and I can do some more research on it, is, it's kind of aligns with the other intention. With the other program, and so they'll probably release some sort of information on that. But right now, I don't know anything specifically of a carve out for the $10,000.
Okay. If you take the 10K grant, does that qualify you from the PPP, or can you only take loans from both?
If you do, they're going to fold it into your PPP loan. They're going to refinance your EIDL loan. You can get both EIDL and PPP, but you have to make sure that they're not used for the same purposes. The specifics on that, not clear. That is basically all they've said.
Well, even though today in the confusion you could probably get away with it, eventually there'll become a day of reckoning,
yes, there will. Yeah,
there will be a day of reckoning. How does the SBA Express work into this? If you initially not approved here, you can go there. Fill in some corners on that for us, would you please?
So if you're talking about just a standard 7A loan, including the Express portion of that, those still exist. Excuse me. They've increased the size of the Express loan from, I think it was $350,000 to now it's up to $1 million. So the point being is that less documentation, less requirements to get that loan. But that loan is still again, much high, it's going to have a much higher rate if it's a standard loan, in terms of that program. My gut is, and I don't know this, is I'm guessing the SBA people are entirely focused on the PPP one. So any of those other loans are kind of pushed off to the side for now. And maybe in a few months, they'll begin actually really looking at those. So, I would kind of wait, but I think the express loan expansion to $1 million, is until the end of the year. So there's a great opportunity to get a great loan, after these PPP loans.
So it comes back to this concept of, can I double dip? And the answer is you might be able to get away with it, but eventually it'll come back to you, and there's no.
Yeah, I mean, it's kind of double dipping, but that one really isn't, because that express loan is a different lending program, different rate, and there is personal guarantee on it. So you can't double dip on the forgivable part. That one they're gonna come after you.
Well, James, you have exhausted our question. You filled our brains. We can't thank you enough for your level of expertise and detail. I know this will spawn a whole other series of questions, and we'll hopefully get more of your time in the future. But I want to thank you so much for making yourself available on such short notice. UBS Wealth Management is one of our partners and one of the people we work with. We look forward to learning more from you. And again, I can't thank you enough on behalf of Vistage and our members for the depth and the expertise and the excellence you brought forward. I'd like to thank you very much for your time. I wish you the best in quarantine. I have one last question for you. As a Red Sox fan, how are you going to get through the no season? I'm a Cubs fan. Same thing. How are we going to get through this?
It's brutal, and what the only good thing I can say about this is that our star pitcher is on. He's going to get Tommy John surgery, so at least he's being tied up in times where there's no games. But it does stink not having any sports, but particularly the Red Sox, especially because, as a Red Sox fan, we've lived through crises of our own, but we'll get past it. And I think that's maybe a good analogy for all of this is stay well, be vigilant on this, keep your employees and your customers in front of mind, and continue to hopefully leverage UBS, but also your Vistage community, because that's how we'll get through it together. So Joe, thank you so much.
James, thank you very much. Thanks everyone for listening, and we'll look forward to our next session. Have a great day, everyone.